Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right. No extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Brian Davis. Brian is a real estate investor, personal finance writer, and co-founder of SparkRental, with over 2 decades in the real estate and finance industries. He owns fractional shares of over 1,800 units and regularly contributes as a real estate and personal finance expert on Inman, Bigger Pockets, RE Tipster, and more. Along with his wife and daughter, he spends most of the year abroad, traveling and living by his own rules. He loves hiking, cooking, pairing wine with said cooking, scuba diving, and occasionally surfing. He says badly, but I'm sure he does fine with that. Most of all, he loves showing others how they too can create their ideal lives through real estate investing and lifestyle design. So, Brian, welcome to The Wealth Flow.
Keith, thank you so much for having me. Super excited to be here.
Yeah, I'm excited to have you there or have you on the show, and just really kind of want to start with your background and where you grew up and what eventually led you to real estate.
Yeah, so like many people, I fell into real estate by accident. I fell into my career by accident, like so many of us do. I did not have that intentionality that I try to live my life by today. I did not have that back then. I was 22, just graduated college, had no idea what I wanted to do with my life. I started just asking around my parents' friends, seeing if they would give me, informational interviews. Just explaining what they did for work, what their day-to-day lives looked like, in that career. One of the guys, he was a co-owner in a nationwide subprime mortgage lending company. This is back in 2003. So subprime mortgages were all the rage in 2003, right?
Right.
It was like cool then. Now it got vilified later, but in those days, that was big. That was happening. So anyway, he offered me a summer internship, basically, right out of college, and I didn't have anything better to do. So I was like, yes, sure. Great. I'll show up on Monday. And, after that summer, I was kind of messing around doing loan officer stuff. But what it turned out that he and his partner needed was not another loan officer just doing regular conforming loans or, subprime loans. What they needed was someone to help them with their side business as hard money lenders. So doing loans for real estate investors, fix and flip loans, purchase rehab loans. So that's what I ended up doing, just because that's what they happened to ask me to do and what they needed help with. So I started working with these real estate investors as borrowers and watching them making money hand over fist. Again, this is 2003, through like 2008 is this period in time. So everybody's making money in real estate, right? There's money going around everywhere. And I'm watching these guys make all this money, and I'm thinking, well, I should do this, right? I mean, like, why can't I go out there and start doing this too? So I did. I went and I took all of my savings because I was living on a pretty small fraction of my income at the time. I was living frugally. So I took all my savings and I went out and just started buying property after property after property. And they were all ill-advised, terrible investments, that as soon as 2008 hit, that became very clear in a painful way, just how badly I had been investing. Because I never learned the fundamentals, right? I never learned how to accurately forecast cash flow. I mean, here I am thinking that cash flow is just the rent minus the mortgage, like every other schmuck out there. I mean, so, I never got a good mentor. I never went out and got an education. I was young and arrogant and thought that I could just go it alone and I could figure it all out on my own. And it didn't help that I was watching all these people making a ton of money, making equally bad investments as I was making. The difference is that a lot of those guys were just flipping and selling out immediately and cashing out. I thought that I was going to be clever and do the Burr method, right, and refinance them and keep them as rentals. And of course, that all fell apart with 2008. It didn't help that I was buying in these very low end, frankly dangerous neighborhoods in downtown Baltimore City, was also very ill advised. So anyway, 2008 hit, my real estate investments collapse, my day job collapses because no one's taking out purchase rehab loans anymore, right? So I'm not actually making any money as a loan officer or account executive doing hard money loans. So I had a total career change, went and started working for this e-commerce company. But my experience in real estate is what teed me up for that job, because the company was they served landlords, mom and pop landlords. They were selling legal forms and other services to mom and pop landlords. So the reason that I got the job at all was the fact that I was a landlord myself, that I did have experience in real estate finance and real estate investing. And I went off and I learned a whole new skill set of online marketing and SaaS companies and e-commerce. And in 2016, I split off with a colleague of mine and we founded SparkRental. And that's a whole nother story. But that's how I got into real estate in the first place, as a long-winded answer to your question.
Yeah. All right. Well, yeah, I went through the 2008 timeframe as well. And for me, it was, I wasn't necessarily in real estate finance, but I was a full-time real estate broker. And that's what I did for a living. And it was almost like somebody just kind of turned off my income. And so that was pretty rough time for me as well. You said you had quite a few rentals in Baltimore. Were you able to sell them, or did you have to just hold on, or what did that look like?
I had to hold on. And a lot of those properties had negative cash flow too. And in fact, some of those properties I had been intending to flip and then couldn't flip all of a sudden because, like you said, it was almost like a light switch being flipped. You couldn't sell anything anymore. And just the entire market just dropped out. So I ended up holding some properties that I had not been intending to hold, and that I had not renovated to hold as rentals. I renovated them for homeowners, so at a nicer finish level. So it especially didn't make sense from a from an investment standpoint. And tenants ended up, of course, trashing those properties, and it was a difficult experience all around, but a very educational one.
Yeah, for sure. So I guess tell me a little bit about SparkRental, and you'd mentioned before the show that it's kind of evolved over time. But when you first created it, what was the concept of it, and kind of take us through the evolution?
Yeah, well, it's one of those things that I have discovered as an entrepreneur, that the business that you think you're in is not necessarily the business that anyone else wants you to be in. And, your customers and the market have a pretty big say in what your business is. So Denny, my partner, and I, our original vision for SparkRental was to have a one-stop shop landlord software service, automating as much as possible for mom and pop landlords. Because, at that time there were some great property management software platforms for larger property management companies and larger landlords. There wasn't anything spectacular for mom and pop landlords. We thought it was an underserved segment of the market. But neither Denny nor I are technical founders. Neither one of us write code. And that too was probably ill-advised, trying to launch a software company without having a technical founder. We hired we thought, we'll just hire that out, right? It's just another skill set. So we hired a real estate or a software development company to build out a software platform. And they got halfway through the project, took most of our seed capital and then didn't actually deliver the software. And they just said, no, this is actually more work than we thought it was going to be. So we're just going to bail on this. Did not give us our money back, of course. So we went back to the drawing board. We ended up launching SparkRental more as an educational platform. And we still went out and built software later on. But to get us through those early days, as an educational platform, we offered a ton of free education, of course, and we also launched a paid online course about real estate investing, about how to reach financial independence using real estate investments. And what happened was, even then, the market for online courses was getting somewhat saturated. Our students and our audience, they kept coming to us and asking us, hey, can we just invest some money with you guys in your real estate investments, rather than going out and having to do this all on our own? And I was living overseas at the time. Denny she lives outside of Philadelphia and didn't want to do any more real estate investing around there. So we kept saying no to people, no, you can't invest with us. And one day we looked at each other and we were like, well, what would it look like if we were to say yes to these people? How would that work? Because we kept getting the same question over and over again. And, that's often the universe trying to knock on the door, right? So we went and we partnered with an investor, a boots on the ground, active real estate investor doing single family investment properties in Michigan. And we did a couple properties as sort of proof of concept, group investments with some of our course students and other audience members. And the returns were good, but it was just way too much work. I mean, we discovered firsthand why no one else was doing that because it was too much work and not enough money. So we went back to the drawing board and we were like, well, what else could we do? And it was around that time that I had gotten into passive real estate investing in real estate syndications, which is just a fancy term for group real estate investments, where individuals can invest just money, be silent partners, basically, in a big real estate project like an apartment complex, become essentially fractional owners in that big property. But there's no work involved beyond just vetting the initial deal. All right. So you're just a financial investor. So Denny and I started looking into those as a possibility for group investments as a club, or like a fraction of a fraction in investment for our club members. And we decided to do a trial run with that, a pilot deal with that. And we had great feedback from our members. And we decided, let's launch this as an investment club, like an old school investment club where we get together once a month, we vet investments as a club, and then whoever wants to invest in that deal can do so with relatively small amounts of money, right? We can all merge our funds together and meet those high minimum investments that those deals have. Those deals typically have $50,000 to $100,000 minimum investments, which is somewhat prohibitive for everyday working people, right? And even if you have $100,000 sitting around, doesn't mean you necessarily want to park it all in one single deal or one single property. So yeah, so our that's how our club was born. We kind of meandered our way into it or fell into it by accident. But yeah, the way it works, $5,000 minimum investment per person per deal. All deals are optional, of course. And $5,000, it's not chump change, but it's a far cry from $50,000 or $100,000 that you normally have to invest in these passive real estate deals.
Seems like a great way to start to experience some of those potential investments where you normally would have to, like you say, put in at least 10 times that amount on most deals. I know there's some that are a little less than 50 on occasion, but it's pretty standard to have 50,000 as the buy-in. What's the structure like on that, Brian? I know a lot of times you can pull together folks and be part of an LLC and do something similar to what you're talking about. But I think in most of those cases, you need to be what investor?
Accredited investor?
Accredited investor. Yeah. Sorry.
Hey, no, I get it. I have those moments myself. Yeah, so that's part of the mission of our club is we only look at deals that allow non-accredited investors.
Perfect.
So
Okay.
we do form a new LLC for each individual deal. Any club members who want to participate, they get listed as owners of that LLC. The LLC itself becomes the LP, the limited partner investing in the syndication deal. So it only takes up one non-accredited investor slot in that deal, because one of the limitations, I don't want to get too far in the weeds here of this, but one of the challenges or limitations with accepting non-accredited investors in these deals is the syndicator can only accept up to 35 of them in a deal. There's a hard limit under SEC regulations. So, which is why they have those high minimum investments. At least that's part of the reason why. So we form an LLC, and that LLC is the investor. So it only takes up one of those 35 non-accredited investor slots in the deal. Even though, each of us is only putting in $5,000, $10,000, whatever each person wants to put into that deal. So that's the overview of how that works, just from a structural standpoint.
Okay. And then I guess, so you guys get the K1 issued to the limited liability company. And then how, from the standpoint of depreciation, different things like that, does that divided based on how many shares you've got into the LLC?
Yeah, exactly. It just gets divvied up proportionately among our members,
Okay.
based on their personal investment.
Yeah, that's pretty neat. And it's neat that everybody has an opportunity to kind of decide which potential investments to not only hear everybody else's perspective. I can see a lot of advantages of that. You get in a room with several people. Some people are going to be able to poke certain holes through certain deals, and just hearing everybody's feedback seems that it would give you a good sense that, yeah, this seems like it really is a good deal. I don't think I'm missing anything here.
That's actually one of the things that is not a hidden benefit of this club, but it's one that is underappreciated, is the community aspect of it. So I'll give you a couple of just quick examples. We were vetting a deal a few months back. It was a deal outside of Dallas, Texas. And I've never been to Dallas personally. I don't know anything firsthand about the Dallas market. There was a woman in our club who lives 5 minutes down the street from the apartment complex that we were vetting, that we were looking at investing in. So she was able to give us, the boots on the ground perspective on that neighborhood, on the kind of tenants who live there, on the demand for housing there. And she was basically saying it's a great area. There's not enough housing, especially for the younger professionals and those young families who are the target demographic for this property. There's just not enough housing for them. We ended up investing in that deal. So it was great to have that perspective, which I didn't have, right? I mean, and no one else in the club did either. A couple meetings ago, we had a woman who she's an insurance adjuster, and she was talking about what's going on in the insurance industry right now and some of the challenges. And in the context of that deal, she was questioning whether the sponsor was budgeting enough for future insurance premium hikes for the property, given how that's been such an issue over the last year or so in this industry. Insurance premiums just skyrocketing through the roof. So yeah, I mean, having a community to vet these deals together, there is always someone who's asking questions that never would have occurred to me, never would have occurred to my partner, but which are great questions, or just additional information that we didn't have, niche information or local information. So yeah, that community aspect of vetting these deals together, it's priceless.
Yeah, for sure. It seems like it would be. And what about the from the standpoint of the assets that you're investing in? You mentioned a multifamily deal. Are you doing a variety of various investments, and if so, can you give us a little flavor on what the group has been investing in?
Yeah, absolutely. So one of our core values as a club is diversification. I mean that in every sense of the word. So we are trying to invest geographically in as many markets as possible. We are trying to invest with as many different sponsors as possible, rather than just putting all of our money in a couple sponsors. We are trying to invest in as many different types of properties as possible. I don't know what the multifamily market, for example, will look like in 3, 4, 5 years from now. I don't know what the mobile home market, mobile home park market will look like in 3, 5 years from now. But I know that if I spread my money among a lot of different types of properties, some of them will work out, and some of them might not work out as well. But by spreading your money among as many of these different markets and property types as possible, you're probably going to be okay when it's all said and done. Multifamily is the most common type of property that we invest in, just because it's the bread and butter of real estate syndications. That there's just more of those deals out there. But we have invested in mobile home parks. We have invested in industrial real estate, and an industrial business that was part of that deal. We've invested in retail properties. We have vetted some storage deals. And actually, the last deal we had, it was a portfolio of mobile home parks, but there were storage units in that portfolio as well. So yeah, vacation rentals. We've done a little bit in the vacation rental space. We've done hotels. It's part of the fun. And again, when it takes the pressure off, when you can invest relatively small amounts in a lot of different deals throughout the course of the year. So, if you imagine that you had $60,000 to invest in real estate in a given year, you could put that in a single project, right? Either a single investment property that you own by yourself, or a single real estate syndication deal, and hope that deal does well. And if it doesn't, you lay awake at night, gnawing on your fingernails, or you could spread that $5,000 in 12 different deals, right? And it's probably, at the end of the year, it's probably going to look like a bell curve, where some of them are going to underperform, some of them are going to overperform, and most of them will just kind of be in the middle of that bell curve. But at that point, it just becomes numbers on a page, right? And not something that you have to lay awake worrying about. So I find it to be a much lower stress way of investing. Maybe that's just me.
It seems neat. What about communication of, how the deal is doing? And I guess maybe before we get there, just so I'm clear, so if I'm going to come in as a limited partner on a deal, and when we're doing this through the LLC structure, is that's going to be for one specific sponsor's deal, and you have one of these set up for kind of each one? I guess with an LLC, you have that kind of flexibility.
Correct.
Okay.
Yeah. So one thing that's worth just reiterating is that we are not a sponsor ourselves. Like, we're not selling securities. We don't get a cut of any of the money that is invested by our club. Quite the opposite, actually. We're investing our own personal money in most of these deals. So, and that is important because we certainly don't want the SEC knocking on our doors, right? And in order to comply with the SEC and not be considered selling securities, like we can't touch any of the money ourselves. We can't take a cut of any of that. So the LLC is, you could almost think of it as like a joint venture where, we're all just collectively investing in the same thing, but there's no one who's taking like an asset management fee on our side. I mean, the sponsor, of course, does, but they are the ones who are selling securities, right? So
that's right. That's right. What about on that same note, though? I know you're not taking a asset management fee or an acquisition fee, but what about the formation of the LLC, those kind, like the admin type stuff? Are you able to allocate something to kind of offset your expenses?
So those expenses are just paid by the LLC itself, right? And those are expenses incurred by the LLC.
So everybody's contributing a little bit to that. Yeah.
Exactly. Yeah. I mean, everyone's just paying for those proportionate to their ownership interest. But those costs, it's important to us to keep those costs at a bare minimum. So I'll tell you exactly what those costs are. I mean, so we create Pennsylvania LLCs. It's $125 to create it initially. There are no recurring like annual renewal fees in Pennsylvania for LLCs, unlike most states. So it's just a one-time formation fee. We do have to pay an accountant to split up the K1s and give everyone their own individual K1. But we have negotiated a bulk deal on those accounting fees. I think for 2023, I think the deal we negotiated was $250 per LLC. And the accountant did say, it'll probably go up next year. So
Right.
it'll probably be something like $300 an LLC next year. But, given that there's 10, 20, 30 people, paying for these LLCs, these are very small amounts of money to administer this LLC every year. And again, Denny and I aren't getting any of that. That's just money that's charged by the accountant or the state of Pennsylvania. So those are really the only two fees that I can really think of. So
Okay.
it's very, very low overhead LLCs.
Yeah, for sure. And you're right. Most states do charge. I know for a little while there, in fact, part of the reason I moved out of the Nevada area was just the ongoing. I mean, it added up quite a bit. As you're doing that. So, okay, cool. Is there really good protection for Pennsylvania or LLCs? I know they kind of say certain ones are better than others, but what you've been able to find so far is that it serves the purpose and protects you.
I'm not an asset protection attorney, and I know very little about asset protection law, but one of the advantages to passive real estate investing in syndications is that we don't take on any legal liability, right? As limited partners, as LPs.
That's true. Yeah.
And we don't take on any loan liability either. So those are two of the big advantages of actually passive real estate investing in general over active real estate investing. I mean, I've been sued as a landlord several times. So, landlords do get sued. As an LP investing in these, no one can sue you. So,
Yeah.
I mean,
No, that's a good
technically,
point.
Denny or I could be sued by one of our members if someone got upset about something. But, knock on wood, that hasn't happened, and we certainly hope that doesn't happen. We try to be very, very clear about exactly what we're doing and the risks that are involved in real estate syndications. And we're not taking any money from any of these, so hopefully we never get sued.
Right.
But yeah, I don't see a lot of liability on our side or in these LLCs in general.
Okay. And then what about the reporting? I know you said you have a kind of an accountant that'll split up the K1s, but just obviously the LLC is receiving either quarterly or monthly updates from the sponsor. Then how is that shared to the various members of the LLC?
We keep it really simple, and I just hit forward for the email.
All right.
Makes
sense.
It's low tech around here.
That's awesome.
But no, I'm of the opinion that simpler is better in systems of any kind. So the easier that we can keep this for everyone involved, the better.
Yeah, makes sense. And so, and you said, when did you start Spark Rental?
We founded the company in 2016.
Okay.
We started doing group real estate investments in our club, 3 years ago. We started doing our current incarnation in mid 2022 with the passive real estate investments.
Okay. And then how are you getting, I'm sure many people are more than willing to present, what they have to your investment club. But, what are some of the criteria that you guys look at for somebody you're going to bring in?
Yeah, I mean, the longer the track record, the better. We don't want to invest in brand new sponsors for the most part. We have made one or two exceptions to that rule. But in general, we want to invest with the most experienced sponsors possible to try to limit that risk factor. And, like you and I were discussing a few minutes ago, all the better if that sponsor was investing actively back in 2008 and has been through a few of these cycles. Because I do find that real estate investors who lived through 2008 just have a different way of looking at investing, or really all investors, not just real estate investors, but stock investors too. People who were actively investing back in 2008 and lived through that crisis, they just have a different way of seeing investments, and a little bit more of a defensive way, or defensive may be the wrong way of putting it, but they're just more cautious about
Sure. I agree.
dotting their I's and crossing their T's when they're doing their underwriting. So we like to see that, of course. But yeah, I mean, so looking at contingency planning among sponsors is important to us. How are they limiting their risk? For some of the larger risks in this type of investing. What's their track record like? What kind of returns have they delivered to LPs in the past? How many deals have they done? How many years have they been investing? The main way that we find sponsors in the first place is through other sponsors. So whenever we speak with a sponsor, the last question that we always ask them is, who else in this space do you know, like, and trust? Maybe people who you've invested your own money with as an LP, but not necessarily. And that's how we have found most of the sponsors who we have worked with, is word of mouth from other sponsors.
Yeah. Okay. Sounds good. As people are investing, obviously, as you're looking at different deals, and everybody's sort of weighing in on, what they're seeing in this particular deal. I'm sure everybody brings a little something extra to the table. Who's really helping to analyze whether the assumptions that are in there, underwriting make sense? And is it just kind of a collective with the group, or is there anybody that kind of leads that?
It's collective as a group.
Okay.
Denny and I look over these deals before we propose them to the club to make sure that we're comfortable with them. But we don't vet these deals. We have to be very careful from a legal standpoint to say that we are not vetting these deals on anyone's behalf. That everyone needs to do their own due diligence with these deals. So we vet them as a club. But yes, Denny and I do look over the deals before we propose them in the club as an investment. And in some cases, we take votes in the club on what next deals we want to look at more closely, and which sponsors we want to bring in to speak with the club about their deals. So we try to keep it as democratic as possible, and even that is probably the wrong way of putting it. But Denny and I try to be as hands off as possible and keep this as much of a collective as possible.
Okay. And tell me a little bit about how the club works. And, is there a membership? A club obviously kind of insinuates some type of a membership, but what does that look like? And how often do you meet to vet these deals?
Yeah. So the membership fees are our only form of revenue for this club at this time. Like I said, we're not taking a cut of the money that's invested. So we charge a flat membership fee to be a member of this club. It's $497 a year or $59 a month, either way. And we meet at least once a month. We try to meet more than that, and we aim to do at least one group investment as a club every month. There are some months where that just doesn't happen because we just don't see a deal that we feel very confident in or happy about. And then there are other months where we might invest in 2 deals or maybe even 3. But we aim for an average of about 1 deal a month as a club. In 2023, we did 13 deals as a club, and then there have been some bonus deals that we've thrown out there as well throughout the year. We are just in the midst of wrapping up funding our 13th and final official deal for the year right now. So we bring in sponsors to give educational presentations to the club. We bring in sponsors to answer questions. So for every deal that we do as a club, we try to bring in the sponsor for a direct Q&A so that the members can grill that sponsor directly. We certainly don't want to be speaking on behalf of the sponsors for any of these deals.
Right.
So we want to bring in the sponsors so that our members can ask them questions on video calls in real time. But so we aim for at least 1 meeting a month, preferably 2. Talk about the market, deals that are on the table. We bring in sponsors and vet deals together. We bring in sponsors to teach the club. It's fun. It's a surprising amount of fun, actually.
Yeah, sounds really neat. And what about how many members do you guys have?
We have close to 200 members currently. We are hoping to get that up over 1,000 next year. But yeah, I mean, we're getting to that size where we're in some cases able to get those higher preferential returns because of the amounts that we're investing as a club. So we're kind of right on that cusp where we're able to do that. There was one deal that we were able to do that. We were able to get the better profit split and the better preferred return for our club members. So we're getting there. We're getting to that size where we can start negotiating those better returns than the average investor is receiving on these deals.
And Brian, what amount are you finding that that it really has to be that investment as an LP for you to get those preferential, whether it be the preferred a little bit higher preferred return, better split, whatever it may be? What is typically the threshold that you're seeing out in the marketplace?
Often it's $500,000. It's 500,000 in a lot of cases. Sometimes it's lower. There was a note that we invested in where it was 100 was the minimum to get a higher interest rate on that note. So it just depends on the sponsor. It depends on the investment. But between 100 and 500 is typically what we see. For a typical multifamily syndication deal, it's probably closer to 500.
Yeah.
So this deal that we are investing in right now, I think we're investing somewhere around 381,000 as a club. We're still, some of the money is still flowing in. So we, who knows what the end amount will actually be, but we had 381 in pledges as of last check. And that does not include someone who jumped in today actually on that deal at the very last minute. So it might be close to 400 when that's all said and done. So yeah, we're kind of on that cusp of being able to get those dramatically higher returns than the average LP is getting on these deals.
Yeah, that's really cool. That's certainly one advantage of being able to do it as an LLC, and because otherwise you're having to throw around some pretty big money to to get anything above and beyond what you typically will, and you got that diversity, right? Because you're pulling everybody's money together. So that's great.
Strength in numbers,
for sure.
No question.
How have any of these deals gone full cycle yet, or is it new enough that maybe that hasn't happened yet?
That has not happened yet. The first deal that we invested in, let me rewind. We did 2 single family home investments a few years ago. Those have sold. Those went full cycle. Those are done. But for passive real estate investments, none of those have gone full cycle yet. The first one that we invested in is still being renovated as we speak. That one is performing fine. Most of them seem to be doing well. There's one that looks like it went sideways on us. So that it's still unclear exactly what will happen with that particular deal. Most of them are cash flowing fine. They're in the midst of renovations. But none of them have gone full cycle yet. So we don't have any of that data to present, unfortunately. But every sponsor that we invest with, they do have their own track record of deals that they have gone full cycle with that we can show our members whenever they ask about that.
Yeah, and it's going to be a batting average regardless of everything that you guys invest in, and there has to be some here and there that are a miss. But doing it the way that you're doing it is really good to be able to protect against those hopefully one-offs that don't quite perform. When you say one is, and we are obviously going to get into the details of whose deal and everything, but one it may have gone sideways or whatever. Have they paused any distributions, or is it they're doing a capital call, or what is?
Yeah, so they did pause distributions, and they asked for a voluntary capital call. They did not get enough money, which is what's going on around the entire industry right now.
It is, yeah.
I mean, everyone is wary to put more money in some of these deals that are not doing well. No one wants to throw good money after bad, right? So anyway, on this deal, the lead sponsor mismanaged the deal so badly that the co-sponsors ejected him from the deal, and it was bungled pretty badly from what we can tell. Okay. They are trying. So right now, they didn't get enough money pledged from doing a voluntary capital call. So they're trying to bring in an outside private equity firm to invest some preferred equity in the deal, which of course is bad for us and our returns, right? Because they're going to come in at a higher priority over us in that deal. But the best case scenario for that deal is, the extra money that they need to stabilize this will give them the longevity to be able to hold this, get it stabilized and positively cash flowing, and wait out the market until we have lower cap rates and they can sell it for a profit, 5 years from now or whatever.
Yes.
That's the best case scenario. Worst case scenario is they're forced to sell today and we all lose a lot of money. But yeah, like you said, it's a numbers game. It's an averages game. I think of it as a bell curve. Some deals are going to miss and miss badly. Some deals are going to overperform and do really well, and most will hopefully just be kind of right down the middle in that bell curve. So I invest relatively small amounts in all these deals. I don't lose sleep over if one deal goes south. That's part of what we're doing by spreading our money far and wide instead of trying to invest huge amounts of money in just one or two investments.
Yeah, for sure. Let me ask you this, Brian. Is there anything else on SparkRental that you really would like the audience to know?
I mean, I think we covered it. I would encourage anyone who is intrigued by what we're doing to reach out to us. You can reach me at brian@sparkrental.com. I'm very responsive. You can reach us at support@sparkrental.com. Come attend the meeting is really the best way to really see what we're up to. These membership fees are 100% refundable if you decide it's not for you. So join the club and attend the meeting and just see what we're doing and what it's all about. And if you decide it's not for you, that's fine. No questions asked. Walk away with your money back. But we've had nothing but really positive feedback from people about what we're doing. There's really no one else in the market doing what we're doing right now. So, it's pretty special and it's pretty unique.
Yeah, for sure. It sounds really neat. And let's maybe talk a little bit about the lifestyle. And you're dialing in today from Lima, Peru, I believe you said, and it sounds like maybe you live there right now. But tell us a little bit about just the flexibility and some of the benefits that investing in real estate have done for you.
Oh yeah, I mean, it's a pretty incredible lifestyle that we get to lead. My wife is an international school counselor, so she works at U.S. embassy schools around the world. We've lived in Abu Dhabi for 4 years. We lived in Brazil for 4 years. We just moved here to Lima in June, so we've been here about 6 months, and it's a fun lifestyle. I can work from anywhere in the world, being a passive real estate investor, running an online business that does not have a physical office and does not require me to be in a physical place. So we get to do things like go spend a week in Cusco and Machu Picchu and, travel. And I'll tell you, one of the things that was it reconfirmed why I created this lifestyle that I did. Last December, I got to take what some people call a red month, where you just cross a big red X through the entire month you're in your work calendar and say, I'm not available.
Nice.
And my wife and daughter and I went and spent a month traveling in Argentina and Patagonia, did hiking and wine tasting in Mendoza and, running around Buenos Aires. And it was great. Not many people get to do that kind of thing. That's the kind of thing that you can do when you invest passively in real estate or in anything else for that matter, rather than actively. It's the kind of thing that you get to do when you have a virtual business. So it's an incredible lifestyle. And I would encourage everyone to just be more intentional about designing the exact lifestyle that you want rather than just continuing floating downstream in the current that life throws at most of us. And, most of us just kind of sit back and let the current take us. But be more intentional is a piece of advice that I would give to anybody.
Yeah, for sure. I think so. I think that's great advice, and seems like just an amazing opportunity, not only for you and your wife, but for your kids to be able to, experience that is just, it's kind of a once in a lifetime thing. And I think you're right. A lot of times people follow a very similar pattern. I think one of the benefits of COVID was this disruption from the norm. And there's a lot of folks that have recognized, and a lot of companies that have recognized that the person doesn't necessarily need to come into the office every day to be productive. Some of them, they had to pivot and discovered that, and I don't think it'll ever quite go back to the way it was. But certainly, being intentional about what you really want, I think, is important. So,
yeah, absolutely. Couldn't agree more.
How about, I guess, two questions I ask everybody, Brian, and one would just be, if you were to give advice to an investor, somebody that's maybe just starting in their journey, what would that advice be?
Well, a couple pieces. One is, if you plan on investing actively, get mentorship or a senior partner or a coach or somebody who has been there and done that and done exactly what you're trying to do. Learn from them so you can avoid all those costly mistakes that they made and that I made and that that a lot of us have made. You can avoid a lot of those mistakes if you just get help from someone who's already walked that path. But what I would tell people who are interested in investing in real estate is start easier and work your way harder. Active investing is the hardest type of real estate investing, but that's what people jump to because they watch TV shows about flipping houses, or they're familiar with the business model of landlording, so that's what they know. So they just assume that that's the way that they should invest in real estate. That's the hardest way to invest in real estate. You can go out and you can invest in public REITs, although I actually don't recommend that because they're too correlated to the stock market. But you can, and it's easy. You can invest in real estate crowdfunding with relatively small amounts of money, $10, $20, $100. It's a passive and easy way to get started in investing in real estate. I particularly like Ground Floor. I have a lot of money invested with Ground Floor, and it has done great for me. But there are other platforms as well that are great. And then the next level up of difficulty from there is passive real estate syndications, what we've been talking about this entire show. Way easier than going out and becoming a landlord. It's way less work. But people hear words like private equity, they hear words like real estate syndications, and their eyes kind of glaze over and they get really intimidated. But this is actually a much easier way to invest than going out and actively buying properties yourself. So I would urge people to start on the easy end of that spectrum, work your way to the harder stuff as you want to, and just stop wherever you feel comfortable.
Yeah, for sure. And okay, I got one other one that I ask everybody, and this is for my audience, but it's also for me. I always love to hear what people are reading out there. So a book recommendation doesn't necessarily have to be real estate, maybe just something that you've read that's been impactful to you.
Oh man, well, I'll give you a couple ones. So I like Brian Tracy, and I really liked his Personal Success Made Simple. He got to a point in his career where he was such a big name that he was able to bring in some more like alternative and mindset related things, in addition to the more like hands-on gritty stuff. But what most of us need help with is actually more the mindset and the different ways of thinking about money than just, the nuts and bolts of budgeting, for example. I mean, that's actually the easy part. The harder part is thinking differently about money, thinking more like the wealthy as you approach investing, saving money, etc. So anyway, that was one. I liked Traction by Gino Wickman for entrepreneurs. It's a business book. It's not a real estate book. But any small business owners out there, I would highly recommend Traction by Gino Wickman. On the fiction side, I'm a big fan of A Gentleman in Moscow by Amor Towles. And I mean, I could go on, I could offer a lot of fiction. I listen to a lot of audiobooks, so I'm a bit of a bookworm. Yeah, but yeah. I'll stop at 3.
That's 3 perfect ones. So I appreciate that. Well, Brian, I've really enjoyed our time together on the wealth flow, and I think it's a great option for a lot of people. And so go check out the Investment Club and Spark, and appreciate you being on the show.
Keith, thank you so much for having me. This was a blast. Thanks again.
Yeah, thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.